Welcome back to Financial Literacy for Lawyers, Bridging Law and Business. I'm Professor Seth C. Oranburg, and today we're going to become forensic detectives. We're going to learn how lawyers can use financial statements to spot fraud, misrepresentations, or non-compliance before they become crises. We'll examine practical tools and real-world patterns. We'll reveal how connecting the dots across the snapshot, the balance sheet, the movie, the income statement, and the behind the scenes, the cash flow, can keep you and your clients and your practice safe. So this is where it all comes together, like cross-examining witnesses to uncover the full story for better business advising. If you're integrating these skills for the first time, we'll take it one pattern at a time. I'm going to guide you through this. You don't need expert level knowledge. You just need to know the right questions to ask. Because if you can ask better questions, your clients will have to give you better answers. And then together, you can solve a lot of problems before they arise. This is an educational podcast. For legal advice, consult a professional. Financial statement forensics goes beyond reviewing numbers at face value. It's the practice of analyzing the relationships and patterns between financial documents, especially when something feels off. And part of this podcast or this episode is so that you develop that spider sense. When does something feel off based on reading the documents? Because for lawyers bridging law and business, this means paying close attention not just to each statement individually, but to their interactions. Does the income statement's profit story align with cash flow reality? When earnings should eventually turn into cash? Does the balance sheet's asset growth make sense with reported revenues, or is there unexplained bloating? Think of it as a cross-examination for the numbers. The balance sheet answers, what do we own or owe today? The income statement says, did we make money over time? And the cash flow reveals, is the money really there? When these contradict, that's probable cause for deeper inquiry, potentially uncovering issues before they lead to disputes. Forensic accounting is often at the heart of business torts, partnership disputes, insolvencies, bankruptcy, fraud investigation, and regulatory enforcement actions. Forensic accountants support legal teams by uncovering these discrepancies, reconstructing hidden transactions, and explaining findings to courts or juries in plain English, like translating complex evidence for a judge, making abstract numbers tangible in arguments. But you don't need to be a forensic accountant to ask some basic questions. And the purpose of this series is to train you to know when to ask. So let's talk about some patterns that can emerge. Detecting fraud or business risk in financial statements rarely comes from just one number. So you have to look for patterns in the numbers. The real power lies in looking for red flag patterns across several documents. So we might want to watch for revenue growing quickly without matching cash increases, suggesting premature booking or uncollectible sales. Revenue should eventually flow into cash, so a lag in that process hints at problems. Also, look for sudden drops in expenses or some unusual number of, quote, one-time gains or losses, because those could prop up net income artificially. This might be like labeling recurring costs as exceptional, which sort of beautifies the results, at least in one period, at the expense of another. Another is accelerating accounts receivable, where they far outpace actual collections. This can indicate something called channel stuffing, where goods are pushed to distributors to book sales prematurely, but you don't end up getting cash payments. Then there's large transactions with related parties, and this is especially worrisome at the end of a quarter or a year end. This could hide self-dealing, like favorable terms to insiders not at arm's length, or an attempt to inflate numbers for management who want bonuses at the end of a quarter. Watch, too, for significant changes in estimates or allowances with little explanation, like slashing bad debt reserves to boost profits artificially. Discrepancies between earnings and cash flows, where high income doesn't translate to liquidity, point to non-cash boosts. And swings in key ratios, such as liquidity or leverage, without clear business reasons, you should compare those to industry benchmarks to see if you're an outlier. That's another yellow flag. Reviewing several periods for trend analysis and reading footnotes for unusual circumstances are crucial habits. Case in point, Luckin Coffee in 2020 showed explosive revenue growth on their income statement, a 558% year over year growth. But operating cash flow was deeply negative, and receivables quadrupled. An investigation revealed a $310 million in fabricated sales. That led to their NASDAQ delisting, a $180 million SEC penalty, and investor lawsuits under securities laws. The Chinese coffee chain had used fake transactions with related parties to inflate sales figures. It initially fooled auditors and investors until anonymous reports exposed the scheme in April 2020. So, what are some tools for detection and litigation? Lawyers working with clients or preparing for transactions can use basic analytical tools to enhance their forensic instincts without needing advanced software. These things are like standard discovery methods, but for numbers. The first tool is called vertical analysis. You examine each line as a percentage of total sales to spot irregularities. Like if expenses suddenly drop from 25 to 12% of revenue, that could signal hidden costs or shifted items. The second tool is horizontal or trend analysis. You compare numbers over multiple periods for sharp jumps or major declines, such as inventory growing faster than sales, which indicates possible obsolescence or channel stuffing. The third tool is ratio analysis. Key measures like the current ratio for liquidity, which is assets divided by liabilities short term, or the quick ratio, which excludes inventory for stricter liquidity measures, or debt to equity ratios, which tells you leverage, or profit margins, which are net income over sales. These can all indicate strain. And while you don't have to be an expert in what these numbers are, they're not complicated formulas. And a key thing is to look for their changes. If they're changing rapidly in the wrong direction, that's a reason for lawyers to ask questions. Testing for consistency among the balance sheet, income statement, and cash flows is essential to exposing misstatement or deception. For example, in the Theranos scandal from 2015 to 2018, revenue spikes without cash backing or matching assets were red flags that led to fraud charges in 2018 against founder Elizabeth Holmes for wire fraud and conspiracy, and it resulted in massive settlements and her 2023 conviction. Holmes had claimed her blood testing device could run hundreds of tests from a drop of blood, but it was a sham. She faked demos and had misleading financials, which attracted $700 million in investments before the Wall Street Journal exposed it in 2015, leading to SEC charges and an 11-year prison sentence. Financial statement forensics is not just a compliance check. It's often crucial evidence in transactions, bankruptcy, investigations, and negotiations. It transforms numbers into a business narrative. For instance, in fraud reviews, connecting unexplained transactions or inconsistent revenue recognition can help prove intent or concealment, as under securities laws like Rule 10b-5, where misleading statements lead to liability. In partnership agreements or in mergers and acquisitions, tracing hidden assets or income ensures fair allocation, and using trend analysis can help you spot siphoned funds over time. In insolvency or bankruptcy, uncovering preferential transfers or fraudulent conveyance depends on tracking cash flows combined with asset shifts, and that can support recovery. Forensic accountants provide expert testimony. They translate complex evidence into timelines or visuals. And there certainly are times where we need to call the forensic accounting experts. But one of your jobs as a lawyer is simply to be aware of when it's time to ask some questions. The answers might be forthcoming, or you might flag an issue that someone can fix quickly, or you might make the decision that we've got a real problem here and we need to step it up a level. So, what are some practical risks for lawyers engaged in financial risk management? Here are some steps to apply forensics in your practice. The first step is to request full sets of financial statements for at least 3 years. You don't just want the latest version because you need to be able to spot trends over time. And you don't just want the balance sheet because you need to see all 3 documents together to see if there are discrepancies. You want to spot trends like gradual erosion, and a single snapshot or a single document will miss this. The second step is to cross-check numbers across all statements to find inconsistencies. You can use a simple table or spreadsheet for comparison, or list key items side by side. The third step is to read the management discussion and footnotes carefully. I know, reading footnotes, right? Especially accounting ones, doesn't seem like our job, but these disclosures often reveal more than the headlines, and they can tell you things like changes in estimates that affect profitability. A fourth step is to apply ratio and trend analysis when financials are key in transactions, due diligence, or dispute resolution. You can start with free online calculators if you need to compute without hassles. You don't even have to do the math anymore. And if you don't remember what these different ratios are, it's easy enough to go to a website like Investopia and ask for the key ratios. Or even nowadays, you can go to ChatGPT and just say, remind me what are the key financial ratios when evaluating balance sheets, cash flow statements, and income statements, and it will give you a refresher. The fifth step is to consult or retain a qualified forensic accountant when things get complex. You should know when you're out of your depth, but maintain your own numeracy to ask probing questions and spot issues early. You want to ensure you're an active partner in solutions, including when it's time to step up to the next level. In our next episode, we'll shift from analysis to governance. We'll explore how board members and corporate officers use financial statements to meet fiduciary duties, make informed decisions, and protect themselves from liability. By tuning into that episode, you're going to get more comfortable in the boardroom where numbers are the lingua franca. But until then, I'm Professor Seth C. Orenberg, and this has been Organized.